Netflix is the first tech giant to report their earnings for Q2 2020, and investors were not happy at all with what they saw. The stock dropped over 9% after hours, despite some decent earnings, as investors rushed to get out of this stock. On Friday, when I'm recording this video during regular trading hours, the stock is still down over 6.5%. The general sentiment around Netflix and selling Netflix was still strong. So now, after reporting these earnings, is Netflix stock a buy? But more importantly, what I want to also focus on is, what is Netflix stock kind of signaling to us? And is this kind of a warning for us for other high growth stocks? Now, I personally believe this earnings was kind of a reality check for a lot of investors who thought stocks only go up no matter what. And even though the numbers, like we'll go through in a second, did look pretty good, there were some key details in there that investors were not happy with. And I think that we may see similar trends with some other stocks as well, which we will talk about in this video. So stick around for this whole video. It's going to be very informative. Whether you're a fan of Netflix or not, smash that like button down below. You're definitely going to gain some value out of this, guys. So let's get into it. So here's the high-level summary of the earnings Netflix posted. They reported a miss on EPS, reporting $1.59 versus $1.81 expected. Revenue was around $6.15 billion, which was a beat, but the impressive part was the growth in revenue year over year, which was 25% growth in such a large company, and that, in my opinion, is impressive. They also added 10.09 million new subscribers during the quarter, which smashed estimates. Finally, they had some guidance come in for Q3, around 195.45 million paying subscribers in total, which would account for 23.4% growth year over year. So now, if you're just reading these headlines, you may be scratching your head a bit. Like, okay, sure, they missed on EPS, but everyone knows Netflix is a high growth stock. They reinvest in the business. They spend a ton on original content, and profits isn't their top priority right now. A comparison is always drawn towards Amazon, for example, who was unprofitable for the longest time as they were scaling up the business, and now they pull in massive profits. So people see Netflix in the same light. So apart from that, everything looked pretty good from this headline here. You know, growth, beats, everything looked good. So why did the stock drop? Now, from this table here, I've marked up the most important metrics in my opinion, both on what was reported in Q2 and what is expected in Q3. So let's go through them. First, while revenue growth was strong in Q2, revenue is expected to slow down quite significantly in Q3 to 20.6%. Now, if that's what they actually report, then this guidance would actually mark the lowest growth the company has seen in over a year. Then you, of course, have the net income that they posted, which was a record net income of around $954 million. And this is a strong number reported here by the business. This is despite the fact that EPS did miss this quarter as well, and in my opinion, it's still a very strong number reported here for profits. Then we go down to subscriber growth, and this is truly what businesses like Netflix are judged and priced on. They had a blowout quarter here, guys, with over 10 million new subscribers. But then in Q3, they expect to only gain around another 2.5 million new subscribers. So there's a significant reduction in new subscribers expected here. Now, while this would still mark a 20% year over year growth, the quarter over quarter growth is quite disappointing at 1.3%, which is more or less flat growth quarter over quarter. So that's not very exciting when we're talking about a high growth company like Netflix, which quite honestly is supposed to grow by double digits on most metrics. Then finally here, they show free cash flow was positive again this quarter at nearly $900 million. So this was once again a huge increase quarter over quarter and year over year. So another very strong sign here. So really, objectively speaking, I'm not a shareholder of Netflix stocks. I'm just kind of looking at this from an outsider's perspective, if you will, and I have no bias for or against this company. I think that their earnings was actually pretty strong and the numbers they reported were pretty good. If they continued at the growth rate and the numbers that they posted in Q2, they could be a very profitable business and they could be pulling in a few $1 billion every single year in pure profits. But the key is if they were able to continue at that growth rate, and clearly from their guidance, it doesn't look like that's going to happen. Here we can see a graph that Netflix themselves has shared with us. and pretty much lists out their subscriber growth for the last few years, and we can see the drastic spike in 2019 Q2 thanks to the global issue. But if you look closely at this, June actually saw a decline in subscriber growth, it seems, which is concerning. And guys, the projection for the rest of 2020 looks like any other year. So it seems like the recent spike we saw in sub growth in Q2 seems to have been short-lived. And now we're going back to slow and steady growth once again, which means that no more huge increases in subscribers and profits and all that kind of stuff is expected. From a financial standpoint, the company did have a strong quarter, and this gave them the opportunity to really strengthen their balance sheet here. And you can see here that they increased their cash significantly from $5 billion to over $7 billion in the last 6 months. Total assets now sits at around $37 billion. And on the liabilities front, current liabilities sit at $7.6 billion and total liabilities sit at $27.8 billion, with $15.2 billion of that coming from long-term debt that they hold. This is an okay balance sheet in my opinion. I think the cash balance is really good to have, but they have a lot of debt and liabilities which could pose a risk at some point. But to be honest, for the foreseeable future, there's not much of a concern here that I personally see. So clearly we can see here that while the Q2 earnings for Netflix were strong, the guidance was pretty disappointing, and when we look deeper into their earnings report past the headlines, there's a lot of red flags and a lot of things that investors weren't really too happy with. Subscriber growth is one of the most important metrics for a business like Netflix, and they had a blowout quarter, like no other way to say that, in Q2. But then Q3 is one of the most disappointing quarters expected. So I mean, the stock has to correct when there was so much optimism, and now we're kind of getting a reality check on it. Now here's the thing, from the March lows, Netflix stock is up over 75%, signaling strong optimism in the company. And if we look at the 1-year chart, it shows us just how much of a tear this stock has been on, as it has posted pretty strong guidance prior to the global issue as well. And here's what I really want to get across to you guys from this video, and that is that Netflix stock is priced to perfection. They're not the only company with this. We'll go through some other names in a second, but that's important to keep in mind because investors were expecting this, but they were only able to deliver this. Now, it's no secret that stocks like Netflix, Zoom, Shopify, other stay-at-home stocks have benefited greatly from the global issue, and because of this, there's been a ton of new money flooding into these businesses, pushing the stock prices to sky-high valuations. And when valuations are that high, expectations are also that high. So any sort of bad news, whether that's in the current report or in guidance or anything around the business, triggers a sell-off like we've seen here in Netflix. Let's look at a few other stocks now that are like Netflix, that are pretty much priced to perfection or even beyond perfection in my opinion. And if they report anything negative, look out below. First up is Zoom. This stock climbed from $60 per share at the beginning of the year to now around $250 per share, giving it a market cap of over $70 billion and a PE of 1,470. I never thought I'd see a stock with a PE over 1,000 that was still being bought up by investors because they still see, quote, value in the company. Next up is Shopify. Here's another crazy one. The stock price went from around $400 per share at the beginning of the year, which in my opinion was already a mind-boggling price for this stock, to over $1,000 per share recently, and it currently sits at over $100 billion market cap with no PE because it's still not a profitable business yet in the last 12 months. Yet investors still ask the question, is Shopify stock still a buy? Is Shopify undervalued at these prices? Should I be buying Shopify stock? Oh, if I don't buy Shopify stock now, I'm gonna miss out. Now let's be real for a second. Stock, business, they're two separate things. The businesses are incredible. They are companies that pretty much took advantage of technology and provided us with some really useful tools during these tough times, and consumers benefited from that, businesses benefited from that, and overall they deserve a higher valuation. But when things get skewed too far to one side, like we're seeing right now, investors are too optimistic on these stocks, then they really have such a high standard to meet, and disappointment is most likely going to happen sooner rather than later. That could be in a form of some news being leaked on the company that's negative, or a downgrade, or a bad report on earnings, or anything negative, guidance negative. All of this stuff, or any of this stuff, can contribute to a massive sell-off like we saw in Netflix. And guys, these are not the only businesses that we talked about here that have these massive valuations which don't make any sense. Here are a few more. First, we have DocuSign. This company has a $35 billion market cap, still not profitable, and pulls in around $1 billion in revenue every year. Square. This one's a recent big mover with a $52 billion market cap and around $5 billion in revenue, but again, is not profitable. Datadog, another popular name, $25 billion market cap, and expected to pull in around $500 million in revenue this year. And I could go on with stocks like this, and a long list of high growth names, but these are just a couple to give you an idea that the trend is clear. These are high growth stocks, these are tech stocks, and these are stocks that have benefited or have seemingly benefited immensely from the global issue. As a result, their stock prices are priced to perfection in my opinion, and I'll be keeping a close eye on all of these type of stocks because I think we'll see some pretty good buying opportunities if there are some disappointing earnings. And hey, if Netflix is any indication, I think we have a lot more pain to come for these high growth names. Now guys, you already know I have my cash ready. I've made a few videos on this and I'm waiting to deploy that cash. I really do want to deploy it because I have well over 25% of my portfolio now sitting in cash, and as soon as the opportunities present themselves, I will be buying. And of course, as always, if you are interested in what stocks I buy, when I buy those stocks, and all that kind of stuff, check out the link description down below to our VIP membership group. And you can join that group, join the Discord chat as well, which is part of that membership, and you'll be able to discuss with myself and other members as to what stocks we are buying. Guys, either way, thank you so much for watching. I hope you enjoyed this video, and I hope this video provided some value to you and gave you some perspective on what to expect this earnings season. Netflix is still a great business, and a 6-7% pullback is nothing too crazy, but a smaller growth company reporting disappointing results could see their stock drop 10, 15, 20% in a matter of minutes. So keep that in mind, just throwing that out there. I wish you guys all the best, and hopefully we'll see some deals here in this earnings season. But either way guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.